All right, let's dive into the simple, powerful, and honestly often misunderstood ideas of one of the greatest investors ever, Warren Buffett. We're going to break down 5 of his core lessons that could totally change how you see the stock market. So take a look at this number, $467,650. Now, that's not the price of some fancy car or a small house. No, that is the price of one single share of stock in Berkshire Hathaway, the company Warren Buffett runs. Insane, right? So the big question is, how did this guy, the guy they call the Oracle of Omaha, build this absolute empire from the ground up? And maybe more importantly, what are the key principles we can actually use in our own lives? Get this, his journey started when most of us were, still in grade school. He bought his first stock at just 11 years old and had his own investment fund by 26. This just goes to show you, this isn't about some lucky break, it's about the incredible power of starting early and just sticking to your guns year after year. So what's the big secret? Well, it all kicks off with his first lesson. And it's not a stock tip. It's a total shift in how you think. It's all about thinking like you own the place. And Buffett does not mince words here. He's basically saying the stock market is not a lottery ticket. It is not the place to make quick speculative bets. If that's the kind of action you're looking for, he's got a different suggestion for you.
And this is really the key difference. See, a trader buys a price hoping it'll pop up tomorrow. But an investor buys a piece of a real business because they believe in what that company can do over years. You're not just gambling on numbers, you're becoming a part owner. It's the difference between playing the slots and owning the whole farm.
And he's got this perfect analogy for it. You wouldn't freak out and sell your house just because someone threw a lowball offer at you one afternoon. So why would you do that with your piece of a great company just because the market is having a moody day? So the bottom line is this. If you've actually done your homework and you believe in the company you've invested in, all that daily market chatter just becomes, well, noise. You're focused on where the business is going in 5 or 10 years, not how the market feels on a Tuesday.
Okay, that mindset leads us right into lesson number 2. Once you're thinking like an owner, how do you actually start building your portfolio?
Buffett has 2 famous rules. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And the key to that is diversification. Don't put all your eggs in one basket. Instead, you own little pieces of several strong companies that you actually understand. That way, if one of them stumbles, the others are there to hold things up.
And here's the best part. You don't need a huge pile of cash to get started. Buffett is a huge fan of a simple but super powerful technique called dollar cost averaging, or DCA for short.
The beauty of DCA is just how simple and automatic it is. You just pick a set amount of money, say $100, and invest it every single month, no matter what. You just set it and forget it. When the market is down, that $100 buys you more shares. When the market is up, it buys you fewer. Over the long run, this smooths everything out and takes away all the stress of trying to time things perfectly.
Okay, so if you're going to be investing consistently for the long haul, we're talking 10 years or more, where should that money actually go? This gets us to that classic debate, stocks or bonds?
Well, let's just look at the numbers, because they really do speak for themselves. According to data from CNBC, a super safe bet, like a 10-year government bond, gives you, on average, less than 3% a year. The S&P 500, which is kind of like a snapshot of the whole stock market, averages over 10%. And Buffett's own company, a mind-blowing 17% average. Every year.
Look, I get it. Stocks feel way more volatile day to day, for sure. But Buffett's whole point is that if you're playing the long game, a decade or more, owning a piece of good businesses has historically been the clearest path to real growth.
So we've covered the mindset and the strategy. That brings us to lesson 3, which isn't about what you should do, but about the one thing Buffett says you must never, ever do. This is his one golden rule.
And let's be clear, this is not a suggestion. It's pretty much a command. Using borrowed money, what they call leverage, is a game that he thinks you just have no business playing. So why is he so intense about this? Well, it's simple, really. The short term is a total crapshoot. Nobody, and I mean nobody, can predict the next big crisis, whether it's an economic meltdown, a war, or a global pandemic. These things happen, and they can make the market drop like a rock, fast.
And here's where the real danger is. If you've invested your own money, hey, you can ride out the storm, you can wait for it to recover. But if you borrowed that money, a sudden drop can force you to sell at the absolute worst possible moment. It turns what would have been a temporary dip into a permanent, catastrophic loss. You get wiped out. So, when you put it all together, what's the big Buffett takeaway? How do all these pieces fit into one clear philosophy?
It really just boils down to these 5 principles. Think like an owner, not a gambler. Ignore the daily drama. Spread your bets and automate it. Bet on long-term growth. And for the love of God, don't borrow money to do it. It's not about being a genius, it's about being disciplined and patient.
And that kind of leaves us with one final question to ask ourselves. When you really look at what you're doing with your money, are you truly investing or are you just speculating? Are you acting like a business owner or are you just pulling the lever at the casino? Think about it. The answer to that question could make all the difference in the world.